Good day, I'm Chartered, your accounting tutor. In today's class, I promise we are going to look at control account reconciliation under financial accounting. This topic is not just common because most learners have difficulty in understanding it, or in most textbooks it is not available. And that is why it is important that I draw the attention that there is a topic under control account called control account reconciliation. And that is why I want to treat it so that they will have an idea that there is a topic called control account reconciliation. What do you mean by control account reconciliation? Control account reconciliation is the process of comparing the balance in a control account the balance in a control account in the general ledger with the total of the individual balances in the subsidiary account to ensure that they agree. Emphasis here is that control account have two areas. We are talking about it is balances that are in the subsidiary books that are now moved to the control account, which is, like I told you, which is a completing aspect of the double entry system. Anything that happen in the subsidiary book, it is a completion of it in the control account. Then it means that at the end of the day, if a control account is prepared, the final balance in the control account should agree with the total balances in the individual subsidiary account. Here we are talking about the return inward, the return outward, and other accounts, bad debts and other accounts that relate to a control account, either receivable control account or payable control account. If the balances, like in the sales A book, if the total balances of debtors is 90,000, it's expected that the amount that will be taken to the control account should also be 90,000. If there is return inward balance in the subsidiary account of, let's say, 10,000, it means it is the same 10,000 that should go to the control account as a completing entry. So at the end of the day, the balance in the control account, the final balance that is derived, should agree with the total balances that is being added up in the subsidiary book. So if there's a disagreement, it means there is an error of either omission, overstatement, or understatement of any of the item which will cause the disagreement. So in the process of trying to bring the difference or trying to detect the difference and correct it is what is called control account reconciliation, whereby the balance in the subsidiary book is now equal or the same with the final balance when preparing the control account. That is what is control account reconciliation is all about. Here, let's look at the importance of preparing a control account reconciliation, or the importance of control account reconciliation. It is clear that a control account is being reconciled with the subsidiary account. First, it helps to detect errors. If errors like omission, overstatement, or any error that will affect the two accounts, if a control account reconciliation is prepared, such errors will be detected. Next, to ensure, because if you prepare and the two balances disagree, it is clear that there was an error somewhere which must be investigated and then brought out. Then next, to ensure accuracy. Just like a trial balance, if double entry transactions are posted, a trial balance is prepared to test the accuracy of all the records in the ledger. So if a contractor is also if a contractor reconciliation is also prepared, such accuracy will be determined, because when the two balances, as I said, disagree, then you know that there's lack of accuracy, and that is why it helps in to ensure accuracy in the transactions that flow between the control account and the subsidiary books. Next, to maintain reliable accounting records. If accounts are reliable, it means that any amount that happen, any transaction that happen in the subsidiary books, in terms of the figure, must be the same with what is taken to the control account. So if the two balances agree at the end of the reconciliation, then it is clear that the records in accounting are reliable for decision making. Next, to identify missing transaction. One of the key areas of control account I told you is to identify the missing figures. So if a control account reconciliation is prepared and it is clear that a given figure is not used, then the two balances will disagree. Then if care is taken for proper investigation, such missing figure will be detected to improve internal control. These are most areas that auditors use in trying to improve internal control of an organization by preparing control account reconciliation to reconcile whether the balances for the subsidiary books that are taken to the control account are the same and balanced at the end of the day. Next, to support decision making, it helps management for decision making if all records are accurate the way they're supposed to be. To detect fraud. Fraud is one of the common areas why management or businesses try to prepare reconciliation of control account, because if reconciliation is not prepared, it is very difficult for you to know that all the transactions all the balance in the subsidiary account are perfectly moved to the control account and the actual amount is moved and no item is being omitted. And if it is such, if there's any fraud in terms of reducing the figure available, you will discover that it will be detected appropriately. So these are the importance of preparing a control account reconciliation. Let's quickly look at how control account is prepared in terms of the items that are commonly found in the two major control accounts, which is receivables control account and then payables control account. Receivable control account and then payable control account. Mind you, we're talking about the reconciliation here. We're talking about the reconciliation of the control, what is in the control account, the items that are posted in the control account in one place, in one account, and then the items that are posted in the individual subsidiary accounts. That's what we're talking about. So in most cases, the common mistakes that are found here is the omission or overstatement or any item that was supposed to be recorded but was not recognized, the same thing as omission or overstatement of a given figure or understatement of a given figure. These are the common errors that you found between the two accounts. Let's quickly look at the common items that are found in the two control accounts, that is receivable control account and then the payables control account. And this is how the control account is being handled. So let's look at it, how such items should be treated in terms of whether they should be added or they should be deducted if such situation occurs. First, let's look at credit sales. Credit sales omission. If there is credit sales, the basic item in reconciliation is for you to know what an item will create if there's an omission to a given account. What the item will create to a given account. If there's omission of credit sales, what that item will create to control account, what that item will create in the subsidiary book, whether the item will create an addition or will create a subtraction from the balances at the end of the day that disagree, that calls for reconciliation. That is the key. This item, if omitted or overstated, how is it going to affect the balance that is being brought down at the end of the day in the control account and the individual balances in the subsidiary book? That is the emphasis of control account reconciliation. You must think very well to know such item and how does it affect the control account and the subsidiary account. Let's look at them here. Number one, we talk of credit sales omission. If there is credit sales omission, for example, if a business have a credit sales and a given amount of credit sales have been completely omitted in the account, but here where the omission is not in both sides. It's either it's omitted in control account or omitted in subsidiary account. If it's omitted in the control account and used in the subsidiary account, it means there will be a disagreement that will call for reconciliation. So not if the two items, if it's omitted both in the control account and also omitted in the subsidiary account, the account will agree, because you not know whether the balance will be the same. But where it is omitted in one account, either deliberate or not deliberate, that is where there will be a disagreement. So emphasis is whether an item is omitted in the control account or omitted in the subsidiary account, how I want to treat it in terms of trying to solve a control account question in preparing it. So let's look at it. If you talk about the credit sales omission, if there's credit sales, you know that in control account, credit sales increase the balances. Credit sales increase the balances. So if there is credit sales, it means the total of the amount that debtors or the customers are owing will increase. The more the credit sales, the more the balances of the customers will increase as they own the business. So if there was an omission, at the end of the day, the balance that will be available will be less compared to what was supposed to be. So if there's an omission in credit sales, it means the omission will be added to the balance that is given that disagree with that of the subsidiary, whereas in terms of the control account. So if there's omission of it, for example, the end of year balance in the control account give 20,000. And if there was an omission of credit sales of 2,000, which was not taken into control account, it means the 2,000 will be less from will be added to the final balance that is given. So here, if there's credit sales, it means the value of credit sales that is omitted will be added to the balance that is given at the end of the year in the control account, which cause disagreement. In the same way, if there is credit sales omission in the subsidiary account, the same addition will be done, because the amount here will be less, while in the other account will be more. So anytime there is credit sales omission, the two accounts should be added. If there's omission here and there's no omission here, you add it here, then the whole thing will disagree. If there's omission here and there's no omission here, you add in the balance given here and the two will agree. That is credit sales omission. Next is returns inward. In returns inward account, if there's return inward, you know that in control account, return inward to reduce the value of amount owned by customers. That is, customers are owing, for example, they are owing 20,000. If they decide to return goods worth 1,000, it means the value that they will owe will no more be the same. It will be reduced by 1,000. So if return inward is omitted in the given account, it means such amount should be less. You less it from number, because it's supposed to less in the control account and then be added in the subsidiary books. Because coming to the subsidiary book, return inward should be an addition. But coming to control account, it means as customers take goods back to the business, it will reduce the value of the debts they are owing. So you less. But coming to subsidiary account, you add. But I'm still repeating that the effect is always in one side, either in one side, and there would have been normal, or there would have been normal, and there would have an issue. That is where you do what I'm talking about. Next, we're talking about cash. Cash as check received from customers. If cash is received from customers, in respect of control account, it means you have to less. You have to less because customers are now paying. If they are paying, it means the balance they are owing will reduce. So if there's an omission, it means the balance will remain high. Then what they pay must be reduced to make sure that you get the accurate amount that they pay, which was not deducted and was omitted. Coming to subsidiary account, you now want add. If there is discount allowed in respect of the control account is now less. It's less in the control account, but if discount is allowed, it means the amount that customers are supposed to pay is less. Because anytime it's not allowed, it means they are not to pay a given amount. Then in that case, the balance they're supposed to pay will be less by the discount that the business have given to them. And that is why it's a deduction here. Here too, it will be less. Coming to discount, coming to account payable. In account payable here too, is almost the same thing with that of account receivable. That is control account receivable. So here we're talking about in payable control account. If there's credit purchases omission, that I say, the amount in the control account will be added back. Because if there's credit purchases means the amount that the business is owing supposed to increase. So if there's an omission or overstatement, it means understatement, it means such amount should be added. And in the same way, it should also be added in the individual subsidiary account to make the two accounts agree. If there's returns upward, here in return upward in the control account, it should be less. The balance should be less. While in the subsidiary account, the balance should be added back. In most account is the issue of omission or overstatement or understatement. If there's overstatement, just for you to think clear whether the amount reduce the balance or increase the balance. If there's understatement, it's either the amount increase or reduce the balance. Here it means critical thinking or have the figure that create an error cause an effect to the ending balance. Then here we're talking about cash/check paid to suppliers. If there's cash or check paid to suppliers in the control account, such amount should be added. But coming to the subsidiary account, it should be deducted because in the subsidiary account, money is going out for payment. So if there is omission, it should be less. Then coming to discount received in the control account, it should be less, and then in the subsidiary account, it should be less also. This is an area whereby critical thinking come into play. These errors are not common, but in case they come, you have to think carefully how the error committed affect the control account balance that is given that disagree with that of the subsidiary book. You have to think critical before you come to a term whether you are to add or to deduct, and that is how control account. At the end of the day, discover that if you do the correct subtraction or addition, the two balance both in the subsidiary, and then we agree to give you one to one. I'll just give a very brief illustration that will demonstrate what I'm talking about, just using a single item for us to justify what I'm talking about shortly as you follow. Don't forget to like and share my video, comment if there's any question, or even share to others that need to have knowledge on control account reconciliation, because I say it is not very common in most of the textbooks around us, and that's why I choose to treat to remember that there is a topic called control account reconciliation. Thanks, I remain chat and keep on following, like and comment to my video so that the knowledge will go viral and most people will have a sound foundation in accounting. I remain chat that. Let's look at, we give a brief illustration of how control account is being solved the way it should. You just using an item. I remain chat that.